Hey guys, this is Wade. How's everyone doing today? Wasn't to have Shane start the webinar, but it looks like he's having some problems with his mic. So I'm just going to start it today and we'll get into it. Can you guys let me know if you can hear me okay? Just type a Y into the chat so I know that that's at least working. All right, perfect. And let me get my screen up here. All right, can you guys let me know if you can see my screen? Perfect. All right, so sorry we took a few minutes getting started there. We are just literally like, what's going on with those mics? And anyway, Shane finally just said, all right, you just need to kick it off. So anyway, apologize for taking a few minutes there. So want to welcome you guys to this week's webinar. We're still working on putting together a better script for these as far as like things to cover and all that. But honestly, we've just been crazy busy on the back end support stuff and just getting processes and procedures in place just to make sure that we can help you guys on the back end in a timely way, not have like 24-hour turnaround times and things like that for responses. So anyway, it's been super busy, but our goal for these webinars and for every week in, week out, and month in, month out is to come out with better content, and putting a lot of stuff together to make sure that you guys are seeing this clearly, and are getting better each and every week that you're putting into it. So definitely have a lot of good stuff in the works. Working on a whole new outline for the online course. I'm still actually putting the PowerPoint together, but I'm just about done and ready to record it. So that's in the works. So we got a lot of cool stuff happening. And I will mention we are going to redo the classroom. It doesn't mean what's in there isn't all you need, but just through doing literally hundreds of coaching calls and doing a lot of interaction with the new subscribers. Just basically I'm learning a lot about the certain minor aspects of the intricacies with the software that we need to drill down on more. So that's what the new course outline content's going to be about, is just really just taking what's already there and just getting it clear and more specific, so you guys have a very clear understanding of how to work with the software and how to navigate the markets with it. So anyway, we're working on that, and got a lot of cool things in the works. Some software updates still working on at the same time. Nothing major changing. We'll never change the methodology, but if we can make it a little clearer or a little sharper, then we will. So we got some cool stuff happening there. And anyway, it's just been awesome. Getting some awesome feedback from you guys. Guys sending in some trades and things that you guys are taking, and I know a good number of you are seeing this right. You're staying in trend, and you're starting to reap the rewards of doing that. You're starting to see the consistency, and more importantly, you're gaining the confidence that staying in trend gives you. So it's really awesome to see that progression. And anyway, you guys are doing awesome. So I'm going to open it up. The main thing we want to do on these webinars is we just want to be here to help you. We can look at markets. We can talk about if you guys are in a specific trade or looking at a setup. I'm happy to look at that on the time frames. Just if you're going to tell us a trade you're in or a setup, what we need to know is the currency, and we need to know the time frames that you're managing it by. That way I can put them on, and so we can look at the same thing you're looking at. But anyway, so I'm going to open it up to that. Any general questions about the software, about the components of the software? I know we have a number of new people that have just recently subscribed, so you guys may have some more basic questions. Totally fine. We could revisit some of those. But anyway, we're just generally here to help you all with whatever questions you have regarding the market. So anyway, I'll open it up and just type in questions as you think of them. And let me see, we got some questions coming in, so give me a few minutes to read up here. And one thing I will tell you, I said on the other webinars, is that if you have any kind of like technological support related questions, like if your license key isn't working for some reason or something like that, you're going to want to send those requests or support requests to, literally it's support@tradeats.com. That is the new support email. So you're going to want to direct everything towards that, or we do have a new form in the online course that is, it's at the top of the online course. It says support requests. So you could click on that, and then there's a specific form that you could fill out that generates a support ticket. That will eventually be the only way that we will accept support tickets, because we're trying to get it where everyone could get in line, and it's not just like a random email like it has been. That was fine when we had less subscribers, but now that we're growing, we really have to have things work in an orderly fashion. That way we don't it doesn't get away from us, and we don't miss things and all that. So we'll definitely direct you guys towards that and here in the future. So let me see here. Question. So first question, which is the best supporting and entry time frame to trade stock and indexes? Well, if you're trading stocks on MetaTrader, you're probably trading CFDs. Because I think it's pretty limited. And I'm not going to even pretend to be the best well-versed trader at stocks. My main focus has always been currencies. I've done stuff with Bitcoin as well, Bitcoin SV in particular, Litecoin, and anyway, so I do know a little bit about crypto. But stocks, especially specific stocks and things like that, I will tell you that those stocks, you do need to understand the earnings reports and things like that. Not you need to understand them, because the patterns are going to play out the exact same way. Our software works the exact same way. We're trying to find momentum and we're trying to find an entry point into that momentum. But you do need to be, there's other variables like gap ups, gap downs, and different things that can happen, especially when the market closes. You do have that variable of close time, whereas Forex, pretty much you have a constant stream of prices. So you don't have like a block of data missing, if that makes sense. So anyway, that's something about stocks. But just in general, if you're trading stocks with our software, whether it be CFDs or if you're using the software on a CFD platform, say like SimpleFX, but you're trading on an actual like TD Ameritrade or some other stock brokerage platform, it's the same thing we're doing, but you just have to time your entries and your exits in line, depending on the time frame you're trading on, with the opens and closes of the markets, because there are risks involved in holding overnight, like I said, with gaps and things. So you really want to be aware of the news releases and things that are going to be volatile to that particular asset, or the asset class, or the particular stock. So anyway, just be aware of that. Indexes are the same thing. They deal with the close of the market, although the indexes are usually more, much more liquid than a single stock. So indexes are going to trade much more like currencies. So it's similar to like gold, what we're looking at right now, trades much more like a currency. It actually trades almost identical to a currency, except that that it does close here in the middle of the day. So it closes just for a little bit in the middle of the day. So you do got to be careful with that. But overall, that's not a huge block of data missing. So you can basically you treat it just like a currency, and you'll be fine. Let me see. Let me catch up on some questions here. Okay. So exiting a trade, what signs do you look for when a trade direction might be out of steam, especially short-term trades like the 5-minute from Robert? Okay. So if you have a specific currency or a specific example I could take a look at, then I can give you much more specific advice rather than just general, Robert. But I'll go ahead and I'll just put up a 5-minute chart and we'll talk about it. So if you're trading a 5-minute, then you're probably going to use an hour and a 4-hour for your directional bias, which is pretty fast. But if you're used to the 5-minute, I do have a lot of guys that do trade the 5, but again, like I said, you just got to be used to trading that time frame. So for instance, looking at gold right now, if for what you're looking at for basically to see if a trade's running out of steam or not, is you have to expect a progression. When if you're trading the 5 into the hour, then your trade is really the hour. I mean, you're expecting the hour to keep progressing and to keep going. In this case, we'd be expecting it to keep going long. So as you get boxes and as you get new formation, for instance, like right here, we popped long on the hour, right here coming through this. See how we get through this expansion line? It comes up, takes out liquidity, it comes down and then holds above that level. That's a clue that it's going to continue in trend. So you're looking at this general architecture right here for the progression that you want, because at the end of the day, you have to, in order to get paid on the trade, the trend has to progress. Okay, so you have to really work on understanding the overall range that you're dealing with, and then as it progresses, as you get in the money, then you have to look at, if you get a new box, it's like, okay, how does this situation have to play out for that hour to continue? In this case right here, obviously we're getting out of session, but right here you can see that the hour is pulling back. You see that we pushed out of the top of this box, came down below, and then see the 5-minute came up, tested the white line. When you stop breaking white lines on your smaller time frame, it's not an indication that the trend is over, but what it is, it's an indication that your supporting time frame is going to start taking a breath against you. Okay, so those are the kinds of clues you want to look for, is when the progression stops and what needs to happen for this trade to continue, to keep going. So when that's not happening, it's not working out. If this 5-minute was going to keep progressing, then this candle would have come up, or we would have got some progression through the white line. But instead, like I said, it held, and now you're starting to see it reverse, and it's pulling the hour short. So those are the things that you want to look for. Now this could be possibly setting up for a new entry, but if you're trading the 5 into the hour, then what this is telling you is that this could possibly run against you for another hour or two. If you're starting to pull that candle red, doesn't mean it won't come back around, but something to keep in consideration. In this case, obviously, given the timing in the session, it's more than likely just going to go flat. But just trying to work it out, that if you were in this situation in session, then that would be something that you'd be looking for. Daniel says, can you show us a trade that you've taken recently? I'm actually working on putting together a whole compilation of live trades that I'm actually talking through as I take them. So I'm in the process of filming those and editing them, but those will be available in the online course. So that is in the works. I'm not going to do anything right now on that, but it is in there. So, or it will be in there, soon. Let me see here. Sorry, guys, I'm trying to catch up here. Okay, just a comment from Simon, just something that he's seen is that since listening to the webinar, I've learned to open every chart with the monthly to see any major trend, then go down to the weekly and daily to see how it's going to pan out. Exactly. That's exactly what you want to do, because what puts the probability in your favor is the fact that the markets do trend. So if you can spot a consistency in the monthly direction, what that means is that the weeks that rotate in the monthly direction have a much more likelihood of trending in that direction. And if the week is going to trend in that direction, what does that mean for the days that are in line in that week, in line with the month? It means that your biggest moves are going to be in that direction. So you basically reverse engineer your trade from the bigger time frames down to the day, down to the weekly, down to the daily, down to the hour, down to the 5 minute even, because ultimately when they all line up, and you have that predominant trend, that's where you can bag some big elephants. Obviously, that takes some work and some practice to be able to understand how to weigh out the different time frames, because you are talking about, if you're looking at a monthly chart, it could take a whole month to pan out. And so if let's say you have a monthly that's long and you have a week that's short, what that's telling you is that there's some discrepancy between those two time frames. And what it's saying is that the month is not over, but potentially the next week or two or more could be going against the monthly direction. So you can trade, but you're going to trade based off the weekly chart in that situation. But in expectation that if the weekly rotates back in the month, you would probably want to get more aggressive. So you just have, and you got to base your time scale and your expectation off the time scale based on how those things play out. Okay, here's a good question. When using a smaller time frame like the 1 minute, what would be a good supporting time frame? Let's see. Okay, so yeah, so it's a good question. Is it not recommended if you're going to use a 1 minute? Should you not pair it with the 5 minute? 1 minute and 5 minute are going to be pretty close. The closer the time frames are together, and this is actually one of the new lessons that I'm putting together, talking about pairing time frames for momentum as opposed to pairing time frames for statistical analysis. The farther the time frame is away, say if it's a 1 hour into a weekly, then you're going to get a statistical edge with that. Whereas if you do the 1 hour into the 4 hour, when those both line up above or below average price, you're going to be able to spot initial or momentum in the moment right away, which does have an advantage especially when you're trying to hold into a trade. So if you're going to trade the 1 minute for a statistical advantage, you're gonna have to go far enough away from a 1 minute, and you're gonna have to probably pair it with probably an hour well, let's show you. I'll show you this trade right here. It's actually watching gold this morning, so I'm familiar with what went on here. So on the 1 hour, you see we rotated long right here, and it went up, and we're above average price. Well, your statistical advantage was that the 1 hour was going to hold long because you had a green candle here, right? So that's showing us the directional bias and where the statistics are headed according to that time frame. And right here was your pullback down below average price, and here was your coming back through up through that expansion line target, and then we held above, and that was really the trade inside the hour. But now if you take that and let me get rid of the hour. Actually, I'll put the hour over here for a second. If you pair the 1 minute to the 15, now you wouldn't have seen the turn on the 1 hour because it's too far away. But if you put the 1 minute next to the 15, then you would have rode this out. You would have saw that we were going sideways here. 15 minute entered a box. We broke out long, and then you saw the reversal back down through the average price. So the 1 minute, it's a little too fast to trade directly into the 15. You do need something bigger to mediate it, like the hour. But the 15 can warn you before the hour turns, is what I'm trying to say. So, you can basically use both, but I will warn you, it is really fast. And to do good on the 1 minute chart, you got to trade something that has a really small spread, according to the overall price action. Reason that I've been looking at gold lately is just because if you look at compared to the general price action, we have a pretty small spread on gold overall. And I know it could vary depending on the type of account you have, but overall, it's pretty small. So you can get away with trading the 1 minute, but if you have a really wide spread, it's going to be really hard to get in the money on a lot of your trades. So that is one thing. Before you even think about trading the 1 minute, just make sure that you look at the spread and look at that according to the general price action and see if it makes sense to begin with. And you definitely only want to trade it in session, like heavy session, like New York, London overlap. You know, that's the only time you're going to want to really do that, so that there's more of a guarantee you're going to get some actual movement. Okay, so let me catch up on some questions, guys. Hang on real quick. I'm going to get a drink of water too. Hang on real fast. Okay, here's a good question. The question is, if you're trading the 1 hour into the weekly and it goes into the box, I'm assuming you're talking about on the weekly chart. I'm hoping that that's what you're talking about. If the weekly goes into a box, is it safer to go to a smaller time scale to look for trades within that box? Like I said, I'm hoping that's what you're getting at. You can do that, but you got to keep in mind that if a weekly is in a box, then there could be very possibly, like, you know, several weeks that have a very tight range and are just very generally whippy. So that's one thing that you do got to be careful with. Typically, if the weekly goes into a box, it's almost a good time to go look at one of your other pairs if you have a couple you're looking at, or I would just take a couple weeks off personally. I just don't, if you're looking, if that's your strategy and that's what you can consistently execute, is the hour into the weekly, and your supporting time frame goes into a box, then that it's telling you real time the kind of activity you should expect on the hourly, which is probably going to be mostly just sideways, flat, and choppy. So it's kind of giving you a weather forecast, if you will. Now, if you break out of the weekly box, that's a volatility signal, because you will eventually move from that expansion level on the weekly. And so the minute you get out of a box, and you could set up ATS Assistant to tell you this, the minute you break the high or low, it'll give you that signal, and that's telling you that currency is probably going to be really interesting to trade in the next month, or especially 2 months, because I mean that's where out of those boxes, once it settles, you know, and it has that breakout, that's where you get 6, 7 weeks, you know, 10 weeks possibly in a row of trending action. And that's really, you know, by the month, by the year, as traders, we really live for that activity. You know, we're kind of playing the table minimum, if you will. Not that I don't gamble, and I don't like to reference gambling, but it seems to work out in some illustration for illustration purposes. But you got to look at, you're kind of playing the table minimum, especially if a trend has already formed, it's already gone. Not saying you can't trade it, but you want to trade smaller. Where you want to get heavier is next to those reaction points, like when you got a new white line, you settle above or below, you know, that's a decision point. And if you go heavy at the beginning of the trend, or what could be the beginning of the trend, you put yourself in a much stronger position, rather than, you know, jumping in when the trend is already gone, like most people do. I'm not saying there's not opportunities, like your grade B trade opportunities that you can get into that. But you have to keep in mind with your leverage and things that you're using that you just don't want to go super heavy, because eventually every single trend will turn. And if you're trading the trend, getting the most out of it, trading every opportunity on that 1 hour into the weekly, eventually you will lose one at the very bottom where you're learning that the weekly's done. So just keep that in mind. So let me catch up on a few more questions here. Hang on real quick. Okay, great question. The question basically is, at the exit of a blue box, I'm assuming on your higher time frame, you're going to look for basically the question is, if you're expecting that the market's going to keep moving, and you get a breakout on a box on your supporting time frame, or whatever you're using for your higher time frame, basically, do you wait for a pullback or you wait for an entry on your lower time frame? And the answer is yes, absolutely. That's what gives you your edge in the market. For instance, we'll talk about, let me see here. Well, we'll talk about the 15, because the 15 on gold had a decent setup this morning. It was actually a hard day in gold, but it still worked out okay. Back over here to the 4 hour. Okay, so 4 hour on gold broke long this morning. It actually looks short. This morning we had the short move. You had the 1 hour coming down through average price in line with the 15-minute, showing momentum, because those are close time frames. So in the morning right here, we had it came up, it held average price, and this was actually a decent momentum setup to jump in. The only problem, which isn't a problem, it just is what it is that we came down, broke through this liquidity line. Banks took that the low of that, and they used it to totally reverse the market. So we had a big shot up long, and this, like, it was just a big snap. It didn't stop. So in this situation, that's okay. If you take a loss on that, you're up through, you're definitely not, if you sold the turn on that, you're not going to go above this this reaction point, this expansion right here. So if you take a loss to there, a lot of people would want to jump in up this. They see it's going, especially if you just took a loss right here, you're thinking, oh, I'm missing the boat, I need to jump in. What you want to do is, because now we're in a new directional bias, you got your 4 hour going long, which is more of a statistical pairing to the 15, rather than the 1 hour being more of a momentum pairing. With the statistics going long at this point, then you want to wait for that pullback. And that pullback right here is, you're looking at these past average prices right here. And also too, coming back, you're looking at, this is the decision point on the 4 hour. So if that trend is going to hold, this is going to be the decision point. So not that this was that great of a trade, but if you were going to get in, you would have waited for the pullback here and got as close to the decision point as possible. And this was the first one, and this would have been the second one, the ultimate one right here. But the fact that the 15-minute pullback, we got a price reaction. You could have bought again here, because ultimately your 4 hour was holding. That overpowers the hour and the 15, and that's what gave you the probability that this was going to climb. But ultimately, we're still kind of ranging out, but it would have put you into the money. Ideally, what you want right now is a little bit more appropriate for a statistical-based trade, would be that the 15-minute is headed short and your 4 hours long right now. And we're starting to get counter trend liquidity. People are selling off the market. So, and now we have a white line to trade against. So what we're expecting, and not that I'm saying to trade this, we're out of session. It's not a good opportunity because of the time. But right now, just in general, if this was happening in the high volume times, buying a dip like this in expectation that you're getting back up to this expansion line is your initial price target. So that's why I always like to give, like, you have to look at those white lines. Those are the dividing points of the market, and those would give you kind of your risk, as far as like where you put your stop losses, where the market needs to get to or go past for the direction to change. So, what you're looking at, going back to the initial question, if you do get a breakout on the 4-hour, you do want to wait for a situation more like this in session, where you have a good chance of trading against that counter trend liquidity coming down through the liquidity line here and getting in the money back up to this white line. And then what you're looking for in that situation is you're looking for it to get through the white line and make progress. Because at the end of the day, if you're going to get paid on this, that 4-hour needs to continue. It needs to attack those active highs and go up. And so this 15-minute would have to get through this white line for that to happen eventually. So you're basically just looking for a strong trade placement, and then you're going to monitor it accordingly. Let me read here for a minute, and we'll get to the next question. Okay, a couple of good questions here. Simple question from Claudia. I trade hourly charts. What higher time frame do you recommend for directional bias? For a 1 hour, personally, you could go, but I like to trade into the weekly. I feel like the weekly, if you understand the weekly direction, any hourly movement against that direction is just an entry into that weekly direction. So I like to pair it with the weekly, and then for momentum, I pair the weekly to the monthly to make me feel like, is the weekly gonna, if the weekly's green and the monthly's green as well, that gives me confidence, more confidence, so that the weekly is going to end green. And if the weekly ends green, then any long positions that you build over the course of that week should end in profit, or at least average out in profit, even if the week ultimately doesn't go anywhere. So that's what I'd recommend is the weekly and the monthly. And if the 1 hour is too fast, switch to a 4-hour. That still works. So a question about active timeframes or active pairs from Avery. Let me see here. So the question is, I'd like to see a list of the most active pairs to look for to cut down on searching for pairs. What you want, if you want active pairs, you need to take your directional bias time frame, and I only recommend focusing on no more than like 2 or 3 pairs. My recommendation. I find that everybody that focuses on more than that, it's just too much opportunity to sort through. Whereas at some point in a pair's week and month and year on that time scale, it will have excellent opportunities. So if you're constantly bouncing between a bunch of different pairs, then what ends up happening is, like, when your favorite pair is not moving, you go jump to find something that looks okay, you get in that, and then the pair that you really understand finally makes a move and you're just not paying attention. So what I find is it's better to just kind of live through the cycles. It's like if your pair's in a box, then it's like you're in a box. You wait till it gives you something to trade, is my overall recommendation. If you need something more exciting than that and you need to have more to look at, if you trade a 4-hour for your directional bias, take the ATS assistant, stick it on a 4-hour chart. You can use charts like down here on the bottom, They don't need to have the full indicator set up. They can just have the assistant on them, put it on a 4-hour chart, and check box expansion on the ATS assistant, because the box expansion is a volatility signal. So if you wake up and you have that running, let's say on 3 pairs, you can check which ones have recently had a box expansion, and those ones are going to be the best ones to trade over probably the next few days, because those are going to be the ones that are going to start to trend. If you look at, you know, IG indexes or you know, things that measure volatility, they measure volatility after the fact. If you want to know the overall most volatile currency pair, it's usually in the top running is pound Aussie. That's usually the one with the biggest volatility, the biggest overall movement. Is it the best to trade? It can get pretty whippy. It can get pretty whippy, but you know, there's a lot of movement there. Maybe that's one that you want to make as part of your, you know, the 1 to 3 pairs that you watch. But it doesn't really matter. Ultimately, whatever you choose to trade, it's just better if, personally, I think it's better if you just stick to 1 or 2 things, and whatever time frames that you can be consistent at, you just live through those time frames. And if it decides to go sideways into a box, then just leave it alone. And when you see those perfect hands come along, you see those perfect setups come along, you go heavy. And the only way you're going to be able to do that is if you're paying attention and you're living and flowing with that currency pair. If you're all over the map, it's going to change your overall consistency. So just my opinion, though. Thanks. Got a trade from Matt. Appreciate it, Matt. It's on dollar CAD. Let me see, 5 minute. It's an hour and 5 minute trade. So yeah, let's take a look at that for you real quick. Okay. A nice little rundown. Okay, let's see here. So I don't know exactly. So I think I know you're on forex.com, Matt. I don't know if our timing is gonna line up as far as the exact candle time, but I'll tell you what I see here overall. It looks like this all reversed all the same. The hour brought the 4 hour around. So it was hard to see what was going on here overall. If you did catch the red 1 hour candle rotating, honestly, the only thing I really see here possibly was jumping in short, trading to this expansion as your continuation, which did work out. But at your risk, if you jumped in on this trade looking for a reversal, obviously the overall trend is down, and I know the weekly is short. So it makes sense that you had an overall kind of consensus that any big daily moves you're looking for should be to the short side for that reason. But the entries here, really the only entry that I see after it's already down and confirmed is coming up through right here above this expansion right now. It's working its way back to. And if I was in this trade, you know, obviously would have tried to pull it at the turn here. But this is, you know, we're getting out of session right now. Good chance we could range back up on the hour up here. So if you were in this trade, that's really the only thing I see. It very well may keep crawling down through the rest of the day and break short, but for a 5 minute, there's a good chance that's going to go flat. But if you did happen to kind of spot that and you had a directional bias set, because let's look at the hour here. Now let's change this to the weekly, going back to the hour paired in the weekly. And I know the dollar CAD's just been crazy whippy since we got out of that box. But we are settled on the short side right now. We had a false breakout to the long side. So that should tell us that we should be even more short now that it's coming down. But you see we had the hour break through this liquidity line right here. That's a potential hour setup if you're using the 1 hour to trade into the weekly direction. So if you were looking at that as a potential to enter on the hour, then you would have been in this trade naturally. But on the 5-minute, there wasn't really a setup in that way. But if you were looking at that and anticipating the break short, that could have given you some insight into selling this down towards this expansion in expectation that we're going to get at least to that level and then continue through. So that's really the only trade, but that was a little bit harder of a trade. I'm not going to lie. That's a little more advanced maneuver. You would have had to been in tune with the higher time frames to pick up on that, rather than just looking at the 5 into the hour. But we're trying to keep it basic. You guys got to understand that the basics in the online course, that's what they are. They're basics. Where you're really going to get in tune with this is when you can look at all time frames and you can figure out the opportunities on different time scales. And that's where if you would have saw this 1 hour, if that 1 hour is going to pay you based off that liquidity line, based off that signal, and that the week is short, which is your directional bias, then that means that the 5 minutes naturally going short. So if you could spot that breakout opportunity, there's nothing wrong with selling that short if you understand what the bigger picture is. Nothing wrong at all. But that's how you got to formulate your trade. And let's talk through scenarios. If you sold out of the bottom of this box, and let's say it came back up and it got back up through this white line, that's where if it came up through here, I would have taken the loss from here to there. Take the loss, because that tells me that the 5 minute could be pulling the hour further long, right? So you have to be ready to make those quick decisions. If it doesn't go your way, you got to cut the losses short in situations, especially if you're jumping into a trade in momentum like that. You can't have as wide of a stop loss. Now the good news is you could trade higher leverage on it if you want to, but when it comes down to having a stop on it, it's like these momentum trades really need to perform right away. If this didn't break out as it did, you want to keep a very tight leash on those. And if it goes back against you, if it got back up through that white line, then like I said, good chances are it's lining back up in momentum with the hour, and the hour is probably going to this liquidity line. But so you can manage that based on the architecture in that moment and figure out those types of things. So but anyway, hopefully that helps you out, Matt, just on the overall kind of diagnosis of what's going on here. Okay, his question is, how do we define the break of a blue box? Do we consider breaking with a body or wick? The minute you get a white line out of the box, it's broke. You just go off the algorithm. So if you don't see a white line, it's not broke. You're still in the box. And the white lines, just so you guys know, they form as soon as price gets above or below the box. They will form. So as soon as it gets out of that high or low and breaks that, you're going to get that white expansion line. So it's pretty straightforward as far as how those form. Just give me a minute. I'm catching up on some questions here. Hang on. This Avery referencing the ATS assistant. I talk about the volatility signals and things in the basic signals. So just go review the basic signals portion of the online course. And I talk more about the volatility signal in that. And then there's also a video that we have on YouTube that's called what to do if your currency pair is not moving. It's something I forget the title, but go watch that video as well, because that's all about timing volatility and knowing when a market's getting ready to move. I would just go check those out. That should clear it up a little bit. So hang on, just catching up on some questions. Hang on real quick. Okay, got a request to look at the pound Aussie. So let me pull that on, or put that on here. Here we are. Gerard, can you maybe be a little more specific of the time frames that you're trading? Because you know, a long or short is going to be relevant to the time frame you're basing it on. So, but I'll give some general analysis until I get that info from you. Let me take a look here. I haven't been looking at pound Aussie very much lately, so let me get familiar with it for a quick sec. Well, weekly is definitely long. We definitely know that. An expansion entry right here. So what I think about the pound Aussie is it's long, but this is one of those things right now that, again, you got to be careful with. I'm not saying don't trade it long, but right now you'd be scaling down your positions or scaling out of positions in general. Possible entry coming up on the 4-hour through here. Once you got above this, this is where you could have started attacking it more aggressive with the 15. Let me see what the price action looked like on these candles here. Yeah, okay. Oops. Okay, here we are. Okay, this goes back to the whole, it's almost like the master pattern video setup. So right here, you get the counter trend liquidity right here. You get a white or a white dot right here on this candle, comes down through, and then starts going long right here. So when we get up through that white line, this is where that price we're talking about it's settling. When you get up through, you get a situation like this: 15-minute spikes down out of the box. If you have ATS assistant set up, this is probably going to give you a grade B trade opportunity right here. Spikes down, holds above this last expansion line. That's a good reference point for a stop loss or to see it rotate from that. Not saying you'll get it there, but maybe you get it at the turn here. You're still under expansion. What you want to look for in a situation like this is that you're new to the trade. The 4 hours coming through average price. It's in direction with the weekly, above average price. So it was primed for this kind of movement. Those are the things you want to look at. You want to be looking at this down here, not up here. Up here, you can see it's starting to fan out and it's starting to get tired. So your probability is getting less and less and less. Right here is where you really want to get interested, is in the sweet spot in a situation like that. You get that counter trend liquidity, you get a position in there, you get another entry right here. But ultimately, remember, going back to the first question, what do you look for when it's going? Is you want to look for progression. You want to look for that we're getting above expansion lines. See, we get above expansion line, comes back, it holds these levels right here, holds those levels, gives you another opportunity here, gets through expansion, holds the level, and eventually it breaks in that fundamental direction. That's what you guys are going to have to get good at monitoring progression. You have to live in real time with these trades. That's really what ATS is all about. It's not about predicting the future with a crystal ball. It's about acting in the moment. It's giving you the reference points. It's giving you what you need to look at to get your entries down and understand the general range you're dealing with. And then after that, it's an expectation of behavior. It's an expectation of a fulfillment of a directional bias. And you need to ask yourself, when you get in a trade, what does this need to look at, or what does my entry need to look like for this to no longer be good? What price does this need to get at, and in what time frame does it need to get there for this no longer to be good? That'll answer your question about stop loss, at least initially. Then your second question is, what does this need to do and progress in what sort of time frame in order for it to fulfill my overall trade, which would be based on, say, the 4 hour into the weekly? Well, if your 4 hours is going to progress, it could take a minimum of 4 to 8 to 12 hours or more, because it's a 4 hour candle. So there's your time expectation. You have to look at, how long am I potentially going to be in this trade? And also your targets can be based on the liquidity lines and things like that. You see, we hit these liquidity lines here, the market used those to further the market, to further push. So when you did get a push outside of that coming through here, you saw we came up through those liquidity lines, and you saw this big push right here represents that market makers were using these liquidity lines to push the market. So putting together those pieces on the multiple time frames is where you're going to overall get better at working out where the market's going to go. And it really just comes down to, you're going to put together a plan based on the framework for the trade, and it either behaves in those parameters or it doesn't, within the time frame that you give it. And that's really, about the best you can get with it. So let me catch up on some questions here, guys, real quick. Hang on. All right, good question from Avery talking about stops. Basically, it comes down to getting stopped out before it goes in his directional bias. And that's really going to come down to understanding the general range that you're dealing with. For instance, right here, when in this type of situation, it's going to be different every time. But if you look at with this box right here, you got to look at the general range you're dealing with. Look a few boxes back. Like this is the kind of the general range. You can measure from this low to this high up here. And this is before this move went out. So and there's no exact science to this, but you're looking at, it's like 160 something pips through there. So if you get an idea of the range that you're dealing with and what can happen, that'll give you some idea that like if you're dealing with 160 pip range on that time frame, that's the most recent price action, a 10 pip stop loss is probably going to get hit. So you have to kind of formulate what's the worst case scenario, where can this thing really run to while still maintaining its good trade status on the higher time frame, and you need to plan for that worst case scenario. So if you have your stop 30 pips away and it ranged out and took you out, all that basically could have ended up being, as long as your higher time frames were still intact, say if you're trading in the 4 hour and the weekly, those are still intact, then those just become better places to layer in positions. So you have to the key to dealing with this is trading a low enough lot size so that you can run multiple positions and not have to worry about one position getting stopped out, but basically on accumulating an average of positions in the trending direction. So my suggestion is just, you got to trade. You'll get better at your entries too. You get better at getting them tighter over time as you learn to feel out the market. But just trade small so you can be creative. When you trade too big and you trade too tight, you lose the creativity that you need to have on the higher time frames, especially when you're getting started. The better you get at understanding how price action interacts with the software, the tighter you can get with your stop losses, because you'll know it's got to perform now, or if it doesn't, it's wrong. And you'll get tighter and tighter with that the more experience you get. Hopefully that answers that question okay for you. A good thing, I mean, just because I know the stop loss is the biggest thing. The best thing I could do is tell you guys to study previous expansion levels, similar to this situation like here. In a true trending move, something that's really has some momentum to it, you'll notice that the expansions literally like keep stacking in the direction. And you'll notice that as it stacks, it doesn't want to go below those previous lines. So if you just kind of just go back and study and get familiar with that, that you'll get just get familiar with how that works and how you can see. Go research the biggest trending moves and line it up with the 4-hour, line it up with the weekly, and go look at how the price action on the 15-minute behaved. Because you want to, at the end of the day, you want to have some recognition as far as when that's starting to play out and when you see momentum start stacking in a direction. Those are the moves that you really want to look to trade. You know, markets that trade, you know, in a situation like this, you know, going sideways, this is much more difficult to navigate. Now you can navigate this, but if you're trading the 15 into the 4-hour, this is a difficult market right here, very difficult. The only way to silence this type of situation when you get your 4-hour in this is to go to something bigger. If you can't understand that directional bias, look to the bigger time frame to clear it up for you. You can always find, no matter what time frame you're looking at, if it looks like it starts ranging out, check a bigger time frame to tell you the story. The bigger time frame always tells the secrets of the lower time frame. So I guess that's probably one of the best pieces of advice I'd give you guys. If you don't understand the time frame you're entering on, or you don't understand a time frame at all, go look at the patterns and the behavior of the next higher time frame and see if that doesn't clear it up for you. So I want to thank you guys so much for your questions here. I'm thinking we're actually going to cut this webinar a little bit short today. I know normally we try to keep them around an hour, which we're basically at right now. I will go overtime sometimes, but I do have some other things I need to get into. So we're going to go ahead and cut it a little bit short. For next week's webinar, what we're going to probably do is we're going to shoot to do it on Tuesday. I don't know the exact time yet, but we're going to switch from Wednesday to Tuesday. And it'll probably be sometime, you know, California time in the morning, 11 a.m., sometime between 11 and 1 a.m. If not, we probably just keep it at 11 a.m. So I need to talk with my brother about that and see what works out. Anyway, but I told you guys before, we're going to play around with the day a little bit and just kind of see what works best for everybody. Anyway, I appreciate you guys being on. Hopefully you got some help from this. Just know we're working on a bunch of new content. We got a lot of exciting things coming out. You know, just hang in there, and you know, the best thing I can tell you guys is, like I said, if I've done any coaching calls with you guys or anything, this isn't supposed to make trading easy. Trading is still a difficult skill set to learn. What this is supposed to do, it's supposed to give you that stable platform to get good at. Other indicators, every other system has settings. You will be forever changing your settings, looking for the best settings that will work finally, that you can just automate almost or act like a robot with. And you'll find that it'll work for maybe a few rounds, and then you go into a losing cycle. And it's very hard to survive those losing cycles if you don't just have an overall skill set of understanding price action. All the best traders in the world, their ultimate strategy is understanding fundamentals on higher time frames and price action. And so what this does is this is giving you price action. You're studying literally raw candle activity, but with exact meaning and purpose based on these lines. That's all it is. And all I can tell you is that the more you practice with it, the more dedication you get, or you give it, the better you get. And that's really, like I said, it's not going to make it easy, but I will tell you, if you stick to it, eventually these lines you'll see they don't change. They never ever change. They show you the same type of activity every day, and the more time you spend with them, especially if you stick with the same currency pairs, you'll say, I've seen this before. I know what the story is. I know what the potential of what's happening is, and that's how you really find your trades at the end of the day. Finding, taking momentum and doing the entries, it's a baseline that we've taught you guys in the online course, but your real intuition in this market is going to come from spending time with these and just being able to understand where the probabilities lie. You're going to get to the point, honestly, you guys that start with this will probably not even need the software at some point. You probably will be able to just look at the market. You would understand where the lines would be, just because you've spent so much time looking at the market in the viewpoint of the 3 market phases and how it's playing out. This is training your brain to classify price action. You don't know it yet. I know a lot of you guys that are still with us or still new with us here, but that's what you're doing. You're training your brain to recognize price action cycles and probabilities. So my best advice is to keep it as that. Keep it in that pure form. Don't try to find specific ways to tackle it, specific stop loss level or stop loss distances. Don't try to put it in that box. Look at the architecture of the chart and formulate probabilities based on your higher time frames, based on the architecture of the lower time frame. Figure out what could happen, and then as it starts happening, trade it. And the more you understand what could happen, what the possibility of it could happen, then you'll get better and better and better at that. And the only way you're going to get better at that is by practicing and spending time watching the candles. And when the candles aren't moving, I'll tell you right now, when I wrote the algorithms for this, I spent Saturdays going through old price data when the markets were off. I drew these lines manually for years. That's how it just became branded in my head. And that's how I understand. I started to see the market as boxes and levels of liquidity and where people are going to get blown out. And that's what ultimately led to this. And that's ultimately where you guys got to get to. If you want any sustainability in trading without having to make your mind a robot, which is very, very hard to sustain. If you want to get in and you want to trade the game, you're eventually going to have to learn how to trade price action like this. And in my opinion, it's just my opinion, there's no better way to classify price action than what we've put together here. So if you guys are up for the challenge, this is the purest form of that price action analysis you're going to get. So, all right, guys. I've got a few questions in here, but I think that's about, hold on, let me see if we got anything else new here and I'll address it real quick. Okay, real quick to follow up on your question, Avery, if you're trading from the US, then, for our time zone, we're pretty limited as far, because the markets really start moving in London. But that's pretty early for us, especially of us that have, kids and family and lives to attend to. So, you want to probably stick with pairs like dollar CAD is a good one, even though it's been pretty whippy, it's getting ready to open up. So dollar CAD is one I'd definitely be looking at because we got the volatility signal on the weekly. And then things like if you want to look at pound Aussie, like you said, this thing is a monster. You can see when this thing moves, it moves like crazy. You just got to make sure it doesn't eat you. That's what it comes down to, because it is such a big mover. But just whatever you pick, just stick with it. Stick with those 1 or 2 pairs, go through the losses and go through the wins, and just don't jump around. I'm telling you right now, your consistency will be way better in the long run if you just commit to becoming a specialist in those few currency pairs. So, all right, guys, with that, I'm going to leave you. I got to jump into some other things, and we will send out an email letting you guys know what the webinar is next week. Until then, everyone have a great rest of the day or night or wherever you are in the world, and we will catch up with you guys soon. Thank you very much for being on.